The financial system can seem complicated at first, but just like the economic system with its supply and demand, the financial system is simple when you break it down into its layers and assets. And that's why today we're explaining exactly how the financial system works in a way that anyone can understand. By the end of the video, you'll know everything you need to analyze the markets from top to bottom. And with that said, let's start from the bottom. The base layer of the financial system consists of cash and so-called cash equivalents. Now, logically, cash refers to physical cash and also to the money you have in your bank account. As for cash equivalents, these are basically any investment that maintains a stable value in the short term and can be easily bought and sold in large amounts, such as short-term government bonds. Now, cash and cash equivalents fall into two categories: public and private. When it comes to cash, physical cash is essentially the main form of public money that exists. That's because physical cash is printed by the central bank, which is a public institution. By contrast, the money in your bank account is technically private because it's issued and maintained by private banks. And as a fun fact, this is why some central banks, like the European Central Bank, are pushing central bank digital currencies, or CBDCs. They can see that as time goes on, currency is becoming more and more digital. This means that eventually private money will be the only form of digital money, and so issuing a CBDC is a way for central banks to still have influence over the increasingly private and digital financial system. And yes, I know that there's a difference between money and currency, but that's a topic for another video. Anyways, when it comes to cash equivalents, an example of a public cash equivalent is short-term government bonds, because these bonds are issued by the government, which is a public institution. An example of a private cash equivalent is commercial paper, which is analogous to government bonds, but issued by corporations. Since corporations are private, commercial paper is a private cash equivalent. Now, this is important to understand because cash and cash equivalents are where most of the money in the financial system comes from. When a central bank prints physical currency, this increases the supply of money, specifically public money. And similarly, when a private bank gives someone a loan, this also increases the supply of money, specifically private money. In practical terms, public and private money are the same. Most people don't know or care that when they withdraw physical cash, they've technically converted private money into public money, or vice versa when they deposit physical cash into their bank. The public physical cash and the private digital cash are identical in practice. Both can be used to buy things. Again, the reason you need to know the difference is to understand where money comes from. And let's use the popular example of quantitative easing, or QE. This is when a central bank buys assets like government bonds and corporate bonds to stimulate the economy in the markets. Contrary to popular belief, QE does not involve money printing, at least not in the public physical cash sense. It involves the central bank creating bank reserves, which can be simply understood as a digital form of public cash. These bank reserves are then credited to a bank, which then converts these public bank reserves into private cash and uses it to purchase bonds on behalf of the central bank. As another fun fact, the reason this is done is because most central banks are legally not allowed to buy these assets directly. They can only do it indirectly in this elaborate process, which ultimately increases the overall money supply. So this begs the question of how exactly things like QE increase the money supply and stimulate the economy and the markets. Before I give you the answer, smash that like button if you're enjoying the video and subscribe to the channel and ping that notification bell so you don't miss the next one. And while you're down there, check out our free weekly newsletter and some of the finance deals we have for our viewers. Just click the link in the description below or scan this QR code on the screen. Now, as most of you will know, central banks typically do QE when there's some kind of crisis or exogenous shock, particularly one that causes the economy to weaken and the markets to fall. For instance, suppose there's an energy crisis of some kind. Most governments would respond by subsidizing fuel costs and increasing investment in energy, but this assumes they already have the money to do this. Most governments, in fact, don't have the money to do this, so they would need to issue, i.e. sell, government bonds to raise that money. There's just one small problem, and that's because of the energy crisis, nobody is willing to buy these bonds. And that's where the central bank comes in. It will create bank reserves to make it possible for private banks to buy all these new bonds on behalf of the central bank. In turn, this makes it possible for the government to raise the money it needs to subsidize fuel costs and increase investment in energy. Obviously, this fundamentally causes the money supply to increase directly. As the government issues bonds, these bonds are purchased by the central bank via the commercial banks, giving the government extra money it can spend into the economy and the markets. What's not so obvious, however, is that there are two other indirect effects at play. You see, government bonds pay a yield. These bond yields affect interest rates. The higher government bond yields are, the higher interest rates are. When bond prices rise, yields fall and vice versa. So, if the central bank does QE and it purchases new bonds and existing bonds, this causes interest rates to fall by extension. In turn, this makes it easier to borrow money and makes existing debts less expensive. In this instance, QE wouldn't just make it possible for the government to subsidize fuel costs and increase investment in energy, it would also make it possible for, say, energy companies to borrow more money to expand their operations, because interest rates would fall as a result of the bond purchases by the central bank. And that's just the first indirect effect. The second is where things get truly fascinating, but also a bit complicated, so listen closely. As you've probably gathered, a lot of money creation involves some form of borrowing. In the case of QE, it technically involves the government borrowing money from the central bank, which lends the money to the government using the commercial banks as middlemen. And yes, I know that it's technically done by primary dealers, but many banks are also primary dealers. Again, a topic for another time. Anyhow, what's fascinating is that most borrowing is collateralized, meaning that if you want to borrow money, you need to provide some asset as collateral for the loan. And believe it or not, but the most popular form of collateral is government bonds, which are technically a form of debt. In other words, most money is created using debt, and most borrowing is done by using debt as collateral, which is wild. The key takeaway is that it's not just the amount of cash that's being created that matters, but the stability of the cash equivalents that are being used as collateral for borrowing, which is where most money creation comes from. When the value of assets like government bonds fall, it not only causes interest rates to rise, but it also causes borrowing against these government bonds to fall. Less money. And pro tip, you can track bond market volatility using the MOVE index, which measures implied volatility in the US bond market. Put differently, it tells you how much bond market volatility investors expect in the future. When the MOVE index is rising, that means bond market volatility is rising or is expected to rise. That means that yields are rising, bond prices are falling, and the supply of money is likely to start falling too. So, in sum then, the base layer of the financial system consists of cash like physical cash and digital currency, and cash equivalents like government bonds and corporate bonds. Almost all the money in the financial system is created at the base layer, but most money creation involves borrowing, and most borrowing is done using cash equivalents as collateral, which need to increase in value for the money supply to grow. This brings us to the middle layer of the financial system, which consists of equities like stocks and similar assets. On that note, when a company goes bankrupt, holders of its shares or stocks get wiped out, and anything that's left of the company goes to holders of its bonds or its debt. This further underscores why cash and cash equivalents are the base layer of the financial system. Bondholders are always given preference. In any case, what's notable about assets like stocks is that their prices are supposed to reflect the current and future revenues of their respective companies. In the modern day, however, fundamentals like revenue are arguably nothing more than narratives. That's because almost every single stock is trading at a valuation that's exponentially larger than its fundamentals. So, what's driving this price action then? Well, three things. the supply of money, attention and/or speculation, and the resulting capital flows. Our hypothetical scenario from earlier of QE in response to an energy crisis illustrates this perfectly. To refresh your memory, QE is when the central bank purchases new and existing government bonds via commercial banks. This gives more money to the government, causes bond prices to rise, and interest rates to fall. The money that the government gets is spent into the economy and the markets. The increase in bond prices means money gets borrowed using these bonds as collateral. The drop in interest rates makes it easier to borrow, resulting in more money creation, and it makes existing debts less expensive, leaving more money left over to spend on other things. In macro speak, it's a flood of liquidity, aka more money. So, where does all this newly created money go? Well, in theory, most, if not all of it, should fix the issue the policy is intended to address, in this case, the hypothetical energy crisis. In practice, though, this money ends up in many places where it shouldn't. This is precisely what happened with the pandemic stimulus in 2020 and 2021. Money intended to help people was spent on goods, services, and assets. In our hypothetical energy crisis, QE would therefore cause not just the stocks of energy companies to rise, but it would also cause all stocks to rise because all that increased liquidity would cause everything to rise. Of course, stocks of energy companies would presumably benefit the most, but it's important to highlight the fact that fundamentals like revenue would play little to no role in which energy stocks rallied. Instead, it would be a combination of which energy companies have the closest connections to whichever administration is in charge of the stimulus, and which energy companies have the most compelling narratives and speculation around future growth. Again, any fundamentals like revenue would be nothing more than a narrative to explain the inherently speculative nature of the price action. And the craziest part of all this is that assets like stocks are also used as collateral for borrowing. So, when the price of some speculative stock goes up, it means that more money can be borrowed against it. In turn, this money can be invested back into the market and spent into the economy. This causes stocks to go even higher and gives the illusion that the economy is booming at a fundamental level. If this sounds familiar, that's because, well, it's practically what we've seen over the past few years. Low interest rates made it possible for lots of money to flow into speculative sectors like technology. This caused the price of many tech stocks to rise. Now, while some of these tech companies did in fact make some big products and services with things like AI, it was speculation, not fundamentals, that drove the price. And as the prices of these tech stocks went up, so too did the propensity to use them as collateral for borrowing. And the more their prices went up, the more borrowing there was, and all this money went back into the markets and into the economy. The outcome was an economy driven almost entirely by AI-related production, like data centers, and AI-related consumption, high-end consumers. Regardless, though, this begs a bigger question, and that's how you can tell when this speculative bubble is going to burst. The short answer is technical analysis, yes, the so-called astrology for men. As silly as it sounds, technical analysis works because it's measuring emotions of fear and greed, which follow predictable patterns. As we've learned, most stocks today trade based on speculation, fear and greed. There is, however, one important thing to keep in mind, and that's that when there's a deleveraging event, technical analysis doesn't work as well, especially in the short term. That's because deleveraging is driven primarily by automated selling rather than emotional selling. So, in plain English, a deleveraging event is where all the stocks and bonds that were used as collateral need to be sold in size, and this is what causes a financial crisis. Whatever the case, though, this brings us to the upper layer of the financial system, which consists of so-called real assets like commodities, including precious metals. Now, we reckon you could include real estate in this category as well. So, consider our scenario of a hypothetical energy crisis. First, more money is created via QE. Then, this money flows into sectors of the market and the economy that are related to energy. The increase in money supply causes assets across the board to rally. Now, in theory, most of this money flows into energy companies and their respective stocks, particularly those with ties to the current administration or the most perceived potential for future growth. In practice, though, a lot of this money gets lost along the way and ends up in other assets, with all sorts of narratives emerging to justify the speculative price action. Eventually, some of this liquidity finds its way into real assets like commodities, which are required to, say, build nuclear power plants. And again, this is what we saw with the AI hype. Eventually, all the speculation and investment created actual demand for resources to build things like data centers. And whereas assets like stocks trade based on speculation, commodities do trade based on actual fundamentals. But this assumes that the rally in commodities is actually being driven mostly by fundamentals, or if it's being driven mostly by speculation that's spilling over from other asset classes. Silver comes to mind here. Now, whereas gold is a monetary metal, silver is more an industrial metal. When silver went parabolic in late 2025, everyone said it was because of demand for AI-related hardware, because, well, silver is required for it. Although there was fundamental demand for silver for this reason, that was not the main driver of silver's price action when it started going vertical in late 2025. That was speculation, and you can see this by looking for Google search trends for terms like silver price, which went parabolic around that time. Newsflash, but it's not AI data centers that are searching for silver prices, it's speculative investors. And yes, it was the same story for gold. Even though banks have been accumulating more and more gold since 2008, this was not the reason why gold's price started going vertical too in late 2025. This was because of speculative investing, with the so-called debasement trade as the narrative. The idea that you have to buy gold because currencies are losing value due to all the money printing that happened long before. Well, be that as it may, what real assets like commodities, precious metals, and real estate all have in common is that they all lie at the end of the liquidity pipe, so to speak. Recall that when liquidity is created using QE, this money first flows into bonds. Then it flows into other assets like stocks. And eventually, that money flows into the real economy through consumption or actual fundamental production. You'll also remember the high-end consumers. In case it wasn't clear enough, that's people who profit from the earlier liquidity flows into assets like bonds and stocks. These people tend to use those assets as collateral to consume, which includes purchasing real estate. Of course, you also have the low-end consumers, who are the people who actually work on and at the newly built power plants and data centers. The catch is that it's the high-end consumers, asset owners, who get access to the money first. The lower-end consumers get new flows of liquidity much later. And that's why you can have situations where the economy is booming, but the markets are falling. The caveat is that many modern economies are driven primarily by consumption from high-end consumers whose consumption depends on asset prices. So, when asset prices fall, it can cause the economy to slow, even if there's still some liquidity flowing into actual production and consumption on the lower end, if you catch my drift. This means that the markets are the de facto drivers of the economy in many countries. And that's a problem because it means that over time, new liquidity flows become more directed towards the high end instead of the low end. The silver lining to this is that this is something which more and more people are becoming aware of, and it means that the next round of QE could be designed in such a way that's intended to allocate more of the new liquidity flows into real assets, into broader production and broader consumption. There are just two small problems with that. The first is that if this happens, it will cause inflation to rise significantly. And that would create a second problem, which is that interest rates would start to rise. This would not only restrict the creation of new liquidity, but also cause speculative assets to fall. And as we've learned, most assets trade based on speculation, not fundamentals. And as we've also learned, a fall in asset prices would slow consumption, which is driven by high-end consumers. In turn, the economy would struggle. Now, the only solution to these two problems is something called financial repression, wherein governments and central banks coordinate to keep costs low and prices high for certain sectors and let the others fall how they may. If you've been paying attention, you'll know that these sectors will likely relate to infrastructure, defense, and others seen as critical to national security and domestic resilience. In these chosen sectors, fundamentals won't matter and speculation will run rampant. But if governments and central banks succeed in allocating new liquidity correctly, the lower end of the economy will experience an economic boom. This is a long-winded way of saying, follow the money. Central banks, commercial banks, governments, corporations, and the collateral used for borrowing. Wherever that liquidity flows is where assets will grow. So don't get too caught up in the narratives. So, in conclusion, never forget. First into safe havens like bonds, then into growth assets like stocks, and finally into the real economy, commodities. When there's a financial crisis or an economic recession, then everything falls as everyone flees into cash, and when central banks step in with stimulus, the cycle starts all over again. And speaking of which, if you want to know why the US dollar could rise in the coming months, then be sure to check out our video about that using the link over here. And if you made it this far, thank you so much for watching, and I'll see you in the next one. This is Guy, signing off.